Good afternoon. Those who are online, can you hear me?
Good afternoon, sir.
Good afternoon.
Good afternoon, sir.
Thank you. Yeah, you are able to hear me. So online, please mute yourself. Those who are online, go on mute. Sir, can we start? Anybody yet to come? Many are there. We are happy that many are here, but okay, many have opted for offline class. That is great. But they are not here. Any message you can send in the group so that they can join us. Oh, up to 1:15. 12:45 is not late. 12:45 is normal time. I left my class by 12:50. Of course, punctuality is required for teacher, not for the student. Correct, no? Okay, let them join. If they have difficulty in finding a good place to eat their lunch, that's also important. Okay, they can come. Just to put a message, that's it in a group. Class is started. All right. So any doubt up to last session, up to whatever we discussed so far, before we commence today, any doubt? This control is with us or it is with the office only, this AC? Not with us. Only accounting for manager is in our control, not this AC. I feel little. You also feel that same thing? Okay, I thought I am only the person. Okay. Okay, those who are online. Any doubt? Up to the last class. Please. No doubt?
No, sir.
No. Assignment, all of you submitted?
Yes, sir.
Second assignment is visible. LMS. It is uploaded. Okay, let me first talk about the second assignment for a few minutes. Then we can talk about how to do it for the 3 hours. So today's class is only on your assignment. Sorry? First assignment submitted? Not submitted? First assignment? Not submitted. Okay, submit it later next semester. There's an option available, no? Repeat you can do next semester. Of course, you're not going to get your degree in another 3 months. You have to wait for 18 months total? 18 months. So before that 18 months, any one day you can submit it. Find a good day, auspicious day, and you can submit it. If you are having any difficulty in submitting in time within the due date. All right. So second assignment is about analyzing the companies. That's a real purpose of this course. Actually, this course, accounting for managers, is just centering around analysis of companies. Okay, you remember in the very first class I told you, we are not going to prepare any accounts. We are not preparing you to be an accountant. We are trying to make you to analyze the facts and figures, what you are finding in the account, financial statements. Okay, so that purpose we are going to do now. Assignment is about analyzing the financial statement of 2 companies. Yes. Analyzing financial statement of 2 companies. What you have to do is you have to select any 2 listed companies in Indian Stock Exchange. Listed companies in Indian Stock Exchange. 2 companies that are belonging to same industry. When I say company, it's of manufacturing company. It is of trading companies. So company only you want? No, I will take an insurance company. I will take banking company. I will take service companies, that kind of companies will have certain specific terminologies in their financial statement. Of course, the base is same, the principle is the same. Okay, everything is fine, but yeah, the terminologies, the way of operation may be different from this trading and manufacturing companies. So you take only manufacturing or trading companies standalone financial statement. What I mean by standalone financial statement, the individual statement of that particular company, not a group of companies. We have a lot of group of companies, right? Tata, Reliance. Okay, they have group of companies. They may also have sometime consolidated balance sheet, consolidated profit and loss account. We don't want that. We take only individual standalone balance sheet and standalone profit and loss account. So the input for you is the profit and loss account and balance sheet, where I can collect these two from the concerned website of that company, those companies. Okay, two companies doing the same business. If you take car manufacturing companies, take two car manufacturing companies. Okay, automobile industry. Okay. If you take any pharmaceutical company, take two pharmaceutical companies, pharma industry. Okay. After that, what should you do? You have to analyze the companies based on the input what I'm going to give you in this today's class. Normally ratio analysis. And you're going to compare the results of those ratios of these two companies, and you're going to prepare a report and submit it. Individual assignment. Last date is from now 30 days. 10th May. Too much time you are giving, sir. No?
No, sir.
No. Sufficient time we are giving. Yes. So it is not too less. Then it is too much of time. Good amount of time. Reasonable amount of time is okay. Fine. Sorry? Yearly part? Today. I thought yearly part 2-3 classes. All right. That also you missed. You were there? Might be I was missing you. 2 classes attend online. Totally 3 classes. This is 4th class. Right? Okay. So what I was telling is about assignment. That's it. I told to give a message to you, asking you people to come and join. That's one point. Second point is assignment. I was asking doubt. Is there any doubt in the previous sessions? I told them to ask. Nobody asked any doubt. So I was happy that you understood everything. Third one is we were talking about assignment. Individual assignment company. That time we joined. You people have joined that time. Okay. Anything if I missed out in explanation of this repetition, you talk with your friends. All right. Any doubt in the assignment? Two companies of same industry, and you have to download their balance sheet and the profit and loss account from their website. Okay, that is your base data. That is your basic data for analyzing. And whatever we are going to cover today in this session, you are going to apply those concepts in analyzing the statement of the two companies. Yeah, listed in Indian Stock Exchange. Yes, yes. Meaning is it should not take any special nature of companies, bank, insurance companies, IT companies, service-oriented companies should be avoided. Why? The discussion what we are going to have today for another 2 hours 45 minutes is based on the analysis of some manufacturing companies. That's why. Telling you in the class about manufacturing company and asking you to do assignment on some other company, you have some doubt. Everything is fine, but the usage, the words, the sales may not be there in bank. Your sales will be there. Purchase may not be there in bank. So that kind of confusion will be having. If you know the analysis, then later you can apply the same logic to a number of industries. Okay. So that's the thing. Any doubt in this? No. Anybody has any doubt? Okay, assignment, submission, and anything relating to this particular course, please contact me. I am your first line of Point of contact. First point of contact. If you don't find me, if you are not able to be in touch with me, then you can go to the next level office. Okay. Right. Can you start now today? Okay. The topic for today is, the next topic is financial statement analysis. Analysis of financial statement. We so far learned how to make journal entries of the transactions which are happening in a day-to-day basis. We have also learned, if not journal entry, it should go to subsidiary books. And later, from subsidiary books or from journal, the transactions are posted into ledger. We tried preparing a ledger and we understood how the ledgers can be prepared. Then the ledger balances are brought into a statement. That statement we call it as trial balance. It is prepared for the purpose of checking the arithmetical accuracy of books of accounts. Then the next stage is to prepare the financial statement of a company, which comprises of balance sheet and profit and loss account. We did prepare one financial statement of a company. Okay, the previous, yes, that. So now the basic purpose of this accounting for manager. So far we learned accounting. Now we are going to learn from manager's perspective, as an analyst perspective. What a company is, what they are doing. Are they going in a right way? Whether they are improving day by day, or is there any problem in the company? Are we getting enough profit? Profit can be known from profit and loss account. But are we getting that enough profit? Profit is 2 lakhs. Okay, sir, it is found out. Is it enough or not? Of course, if you ask enough or not, means nothing is sufficient. It's a money, right? Everybody is greedy about money, right? Any investor in this world, how much profit do you want? What is this nonsense question you're asking? Infinity profit. Nobody is there in this world to tell, no, sir, this is enough. 100 rupees enough for me for investment of 1 rupee. Nobody is ready to say. I'm not talking about that enough. I'm talking about what is your preparation and what is your presentation in the exam. What's the mark given to you? Is it enough for you? That way, are you able to connect investment, sales, how much profit? As a student, attending all the classes, preparing well, writing the exam good. Based on that, how much mark you are expecting? So, mark you are getting 30 out of 50. Is it enough or not? That we are going to check. Okay. Are you able to connect this? The example, right? Suppose an example, take an example. Infosys is earning a profit of 2 crore in the last financial year. Tech Mahindra is earning a profit of 5 crores in the last financial year. Which company is good? Tech Mahindra. Why, sir? It's earning the profit more than the other company. Let's say it is, yeah, good. It's performing better. Another example, normal example, student example. You got 25 marks. Your friend got 30 marks. Who is doing better? You or your friend? He's not telling friend. 30 is better. So your friend is doing better. Is it so? Are you right? Are we right in? Are we all reasonable in giving the answer in these two examples? Anybody is having any other opinion? No, sir. 25 is more than 30. Anybody is here? I am. Anybody? Yeah, that out of is important. No, sir. Simply you are coming and telling my mark is 25, my friend mark is 30. Tell me out of what he has secured 30. He got out of 130. You got out of 30, 25. Who is better now? Who is better now? You are better now. Take the example of Infosys and Tech Mahindra. Tech Mahindra has 5 crore as profit. Infosys was having only 2 crore as profit. Okay. Infosys was having an investment of 10 crore. Tech Mahindra has invested 100 crore. Out of 100 crore investment, they earned a profit of 5 crore. Out of 10 crore investment, this company has earned a profit of 2 crore. Now tell me which company is better. So in absolute term, we are not able to take a decision, or if you are taking a decision also, that sometime lead to misguiding inferences. We take an inference, right? That is misguiding. Okay, misleading. Why? Out of what? So absolute figures are there in the balance sheet as well as in the profit and loss account. With that, if you take a decision, that decision may be misleading you. So we need to have a comparable facts. From that fact, if you take a decision, that may be logical. Out of 100, what is your percentage? So 30%. What is your percentage? Sir, my percentage is 55. 55 is better than 55 is mathematically higher number than that of 30. Now the base is same 100. Out of 100 rupees, out of 100 marks, out of 100 rupees of sales, what is my percentage of profit? Okay, so we need some common platform to compare all these figures of all the companies. So we need to analyze the financial statement. Okay, why do we analyze? Only this only reason is the evident reason. That means evident. We have to compare. Why do we compare? What is the basic reason to analyze the financial statement? Or who will analyze the financial statement? Who is going to analyze the statement? Why do we analyze? If company is in profit or loss, that is being known in profit and loss account itself. Where do you find the profit or loss of a company? There itself is known. Then why do you want to analyze it? Whether I am performing better than competitor. Okay, no competitor is there then. I'm the only company. Within myself, how I was, how I am, where I am going to. Okay, last semester my attendance was 30% out of 100. This semester my attendance is 31%. So I am improving. Why? It's not so. It's improving. No, 1% is increased. So this kind of comparison is called as intra-firm comparison. What I was, what I am. Comparing my profit with my own profit of previous years. Okay, what was my sales last year? What is my sales current year? My own performance I'm comparing in two different points in time. This comparison is called as intra-firm comparison. Those who are online, we are not having any slide or any changing. So it's only accounting ratios are there in the screen. I'll come to that in a while. Okay, right. So intra-firm comparison. Another one somebody told, no, inter-firm comparison. I want to compare myself with my rival companies in the same industry, or maybe other industry also. They're not doing the same business, but the investment, both are having same amount of investment. Every 100 rupees investment in IT industry and the same 100 rupee investment in pharmaceutical industry. Which industry is giving more profit, more return? Okay, as an investor, I have to know all these things. Before I invest in a company, I need to have all these things: industry-wise comparison, company-wise comparison. Okay, as an outsider, as a potential investor, company itself, they are already shareholders. Already they are into the company. They also worried about all this performance. So they need to calculate all these things. You remember in the very beginning, first class, we talked about the users of accounting information. You remember? So all those people, can you recollect one or two? Users of accounting information. Shareholders, government, research scholars, customer, employees, managers, investors. So all these people are interested in analyzing the financial statement of a company in order to derive some of the information or input or data, which will help them to take some informed decision, whether to invest or withdraw their investment, quitting the company, selling off the shares of the company and investing in another company. So like that, there are so many reasons and so many stakeholders are there to analyze the financial statement of a company. Another example, if you're going to a bank to ask for a loan, the company itself is approaching a bank to ask for a loan. The company cannot be given immediately some loan. Take it. We have a lot of money. Please take it and go. No bank is ready to give. But they will disturb you. They will call you. Always we have personal, you will get a message. You are sanctioned with a personal loan of 10 lakhs. In one click, your amount will be credited. After that, you have to go there and you have to submit all documents. So many things are there. Process are made easy, but the basic conditions are still there. We already witnessed the crisis of 2008, subprime crisis when it was 8 only. So we have come a long way, 10, 12 years. So how many years over? 14 years over. Okay. So subprime crisis, simply giving loan and we are not able to collect the money back. So there are so many formalities. One of the formalities is, if you're a company, say what you want. So this is my balance sheet, this is my profit loss account. You analyze it and give the loan. So bank is going to analyze. Suppose you are going to borrow money from the general public. As a company, you are going to issue debenture or you are going to issue equity shares. You are diluting your ownership. That time also, you have to prove that what you are. So you are approaching independent credit rating agencies like CRISIL, Standard & Poor, etc. to rate yourself. So they are asking your balance sheet, they are asking your P&L account, they are asking further qualitative and other data, quantitative data. Based on that, they rate yourself. They give a rating, A++, B+, even colleges are rated, no? Like that, financial rating I'm talking about. So the rating is given. So there are so many people who are interested in analyzing the company's balance sheet and financial, profit and loss account put together, financial statement. If you do so, while you are doing so, we have a lot of tools to do so. Lot of tools. Okay, based on the purpose, your tool is going to be different. There are some number of tools. I'm telling you few. Okay, percentage analysis, trend analysis, common size statement, comparative statement, cash flow statement, fund flow statement, and ratio analysis. We have so many tools. Okay, but we are not going to talk about all those tools in this class. We are going to talk about only ratio analysis, ratios, accounting ratios. Okay, so what is ratio? Forget about accounting ratio. You may be any point in time from your childhood might have studied, mathematics, right? Mathematics, compulsory subject from lower class up to 10th at least, it will be there. What is ratio? Comparing two variables, okay? Taking the percentage of those two variables, okay? Anybody online? Anybody? Try for what is ratio? Okay, it's a mathematical relationship between two variables, two data, two related data. Okay. If the two related data happens to be accounting data, then it becomes accounting ratio. It's simple. In our basic example, I told you 2 crore is the profit of Infosys out of 10 crore of investment. So profit on investment, return on investment, 2 crore divided by 10 crore multiplied by 100 is equal to 20%. So this 20% can be called as a ratio. What ratio it is? It is measuring the profitability of an organization. Profitability of what? Each and every 1 rupee invested in Infosys is resulting in the profit of 0.2 rupee. 20 paisa is the result of 1 rupee. 100 is giving me 20 rupees return. So this is called ratios. So ratios can be of percentage, it can be number of times, or it can be decimal. Okay, it can take any one of these form, number of times, or decimal, or just percentage. Okay, so we're going to study about that only today. Ratios, accounting ratios. Yeah. Anybody has any doubt up to this? Is it visible? This particular word, PDF file is visible.
Yes, sir.
Yes, sir.
Yes. Look at this simple example. Profit is 10,000, sales is 1 lakh. And percentage of profit is 10%. Another example. Profit compared with investment, profit compared with sales. We're going to discuss all these ratios today. Okay, what is the objective of ratio analysis? The very basic objective of ratio analysis is to know the areas of the business which need more attention. That means finding out the limitations. Wherever there is a lacuna, wherever there is a problem, that area can be identified. Okay, suppose you have 3-4 products sold. Okay, which product is giving more margin? We can identify. Which is giving less margin? That need to be given more attention. Next, to know about the potential areas where we can improve further and to get more amount of profit. To provide a deeper analysis. Okay, this is the very important point. Look at the third point. There are 4 aspects given there. To provide a deeper understanding or deeper analysis on 4 things. What are the 4 things? Profitability, liquidity, solvency, and efficiency. Only our class is going to be based on these 4 today. Solvency, liquidity, efficiency, and then profitability. Okay, let us understand what is this. What is profitability? Anybody? What your guess about profitability? If I say profitability, what I mean to say, what I refer to. That's okay. We are gaining something. We are expected to gain something. We are intending to gain something. That is called profit. No, but it is not profit. It is about profitability. What is profitability? The ability to earn profit. That's it. Simple. So compared to your medicine, compared to your science and engineering, commerce and accountancy business are very, very simple. You know, there is a definition. You laugh, but don't laugh at me. What is money? What is money? You don't know what is money? You are a professor, you don't know what is money. What is money? Can you define money? A medium of transaction. Okay. Medium of exchange. Okay. Anything else? The book what I read defines money as money means what money does. Money means what money does. Who is a manager? Gone are the days. But today, if we say one who is managing, then we are asking a question: who are you to manage me? Lateral. I mean, we are having some today. There is no hierarchy, right? Today we are talking about the lateral organizations. You are also equal. I am also equal. You are also employee. I am also employee. So what I'm trying to say is there are some definitions in commerce and business which has its own deeper meaning, but when you say it looks very easy. One of the definitions I told you, money means what money does. It has its own rich meaning in it. Money means what money does, what money is doing. All you told, no? Medium of exchange, all those things. Whatever, even future, whatever money is going to do, that is also included in this definition. Money means what money does. Universally accepted, 3 time period accepted definition. So in that way, profitability is nothing but an ability to earn profit. Ability of what? Ability of whom? That needs to be defined. Ability of a rupee invested, ability of a rupee sold, ability of 1 rupee of sales, ability of 1 employee in the company, ability of 1 square feet of land area in the company. You can take any number of examples for that ability. Okay. 1 employee, what is the profit? So total profit of Infosys is 2 crore. How many employees are there in Infosys? So 2,000 employees are there. 2 crore divided by 2,000 or 20,000, whatever the employee, 2 lakhs. Is equal to profitability of 1 individual. But that need not to be 1 individual is earning only that much profit. Somebody may earn so much, contribute so much. Somebody may be contributing little less. As an average, we are taking it. This is an example. So profitability. Second one, liquidity. What is liquidity? Okay, before going to that, who will be interested in knowing about the profitability of the company? Sorry? Investors. Investor is a very broad term, no? Can we decode it? Shareholders, one of them are shareholders. They are interested. Preference shareholders are interested. Debenture holders are interested. Employees are interested. Then customers are interested. Then suppliers. Why suppliers are interested in your profitability? If you don't earn profit, you won't pay to them. Okay. Supplier of money, financiers, creditors, financial creditors, a bank. If you go for a loan, they are interested about your profitability. Okay, so we'll come back to that later with some profitability ratios. Second one, liquidity. What is liquidity? Cash inflow. Outflow is not liquidity. Actually means cash outflow is liquidity. You are not able to pay your rent. What is the problem? What is the consequence? What's the consequence? Causes and consequence. What's the consequence? Your landlord will come and tell you, sir, the last month, if you don't pay rent further, we have to take a legal action or you have to vacate. That creates a liquidity problem. Why you are not paying rent? Because of you are not having cash. Stock is there, sir. If you want rent, what is the rent? 1 lakh. Take these two furniture. This two furniture is worth for 1 lakh. Take it, sir. Will the landlord accept? No. You are having worth, you are having resources, you are having everything. Asset is there. But what is not there? Liquidity is not there. What is liquidity? So liquidity can be just interchangeably used with the word cash? No. Which can be the ability of conversion of any thing, any asset, anything to money, to liquid cash, to hard cash. Is it so? In this context, it is. Okay. Is it complete in this context? Suppose there is a land, there is a piece of land near to Dayanatha University. Okay. I'm the owner. I'm able to sell it. Today I'm putting a board. Land for sale, 1 square feet, 2,000. I'll be having 1 lakh people lining up in front of that land to buy that land. Will we call that as a liquidity? People are coming and giving you money. So take it. Whenever you are registering, I'll come and register. No, don't worry. You take the money. Please, person, you give me today only. Don't sell to anybody. Because rate is 2,000. 2,000. I can't get it from even Atipale or even Osur, I can't get it. So is that liquidity we're talking about? Conversion is possible. I'm ready to sell. People are ready to buy. Is that a liquidity? No, then something is missing, something you have to add. What is that? Value of the commodity should not be reduced. Changing, okay, increased, okay. In 10,000 worth of land, I'm going to get for 15,000, I'm okay. That is not a liquidity. Okay, I'm okay for that liquidity. But 10,000 worth of piece of land, 1 square feet, if I'm selling for 1,000 rupees, liquidity is there. I mean, the money is received, but with the compromise of market value. Okay, so one thing is without any compromise in the value, market value of the asset, plus one more thing is there. So I want market value, 10,000 is the market value. I'm putting a board, 10,000 rupees per square feet. Rarely I may get inquiries. Sir, what is the size? What is the price? Everything they will ask you. Time. If you want 10,000 rupees, you have to wait for at least some reasonable time. Even though it's a busy market, you have to wait for a reasonable time. So two things, without any delay in time period, without any loss in the market value, if you are able to convert an asset into cash, that asset is having liquidity. These two are compromised from 100% to 80, 70, 60. Then to the tune of that much, the liquidity is less. So liquidity means the ability of converting an asset into cash without no delay in time, without no reduction in the value. Okay, how the company is having liquidity, that we are going to check in the liquidity ratios. The company is able to pay off its liabilities. The company is able to pay off its interest, pay off its rent. How they are liquid enough in short term. Liquid means, sir, I have to sell all my assets and I have to keep all cash. That is not liquidity. We are not talking about that. I told you meaning of liquidity. But how do you measure the liquidity of a company? Whenever there is a due, are you able to pay off that dues? Are you able to have, will you be able to having the cash by converting anything into cash? Not the piece of land of anything. I told an example. Stock can be converted, bank balance can be withdrawn, security can be sold, You can arrange a working capital. You can claim from your debtors. All these things. We'll study that little later. Come back. Next one, solvency. What is solvency? Solvency is a long-term liquidity. Our liquidity is nothing but short-term solvency. What is solvency then? Are you solvent? In engineer, in science, you might have studied, no, solvent, insolvent. What is that? Yes, something you know? Dissolving. What is dissolving in science? What is dissolving? What is it dissolving? You are taking me to too much of science background. Okay, dissolution, dissolving. Dissolving means diluting or making it to be liquidated. Okay, suppose you are putting some metal or some chemical into some acid or some liquid thing. It is getting diluted. It is getting dissolved in that. Dissolved. Okay, but same meaning in a financial background. Solvent, insolvent. What is solvency? Solvency means how sound you are, how financially sound you are in meeting out your long-term obligations. If you're going to a bank and approaching for a loan, they will check for your long-term solvency. After 10 years, you're going to repay that loan. How far you will be solvent in these 10 years? What is your own money? What is your borrowed money? That brings the solvency to the company. If your own money is more than the borrowed money, you are said to be more solvent. If your borrowed money is more than your own money, suppose you are having only 1 rupee, 1 crore you are having, 99 crore you borrowed. Total capital of the company is 100 crore. Now the solvency of the company is very, 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 very poor. Poor. You borrowed 99 crore. Suppose if there is any 2022, COVID 2022, then these companies will be first sold, his property will be sold, everything will be sold because 99 crore he has borrowed. This is called trading on equity. We'll study this concept in the next semester in corporate finance. Please keep in mind, we are analyzing what has happened. How it should happen, you will study in the next semester. Financial management. By managing your finance, transaction took place. The transaction have been entered in the books of accounts that has come and sitting in the balance sheet and profit loss account. We are going to analyze that. So solvency means long-term liquidity, or how best you are able to manage your long-term debt. Are you able to generate income to pay off the interest? Are you able to pay off the loan what you have taken already? Or how much loan you can take further? That's also possible. How much loan can I take further? Sir, I have invested in my company 50 crore. How much I can take loan? There's a thumb rule. You can take 2 times of your investment. So 50 crore if you invested, you can go for a loan of maximum of 100 crores. Already I have a loan of 100 crores, investment of 50 crores. Then I can't go for a loan. If you are going for a loan, you are diluting your solvency. You are slowly entering into the zone of insolvency. But it does not mean that, sir, I borrowed 101st crore. 150 crore already over. 50 own capital, equity capital, 100 loan borrowed capital. I'm going for 1 more crore to borrow. It does not mean that you are insolvent today. But it is having a chance to lead to insolvency if the situation is not corrected immediately. So come back to the medical background. You are a doctor. You are having a patient. We have so many specifications. Blood pressure or BP level. What I say? Right. Sugar level, blood sugar level. So many things we are having some standards. What's the BP level? Normal? 120 by 80 to 120. No. 90 by 120. Okay. So within this range, if it is there, you said to be okay, normal. Suppose you are a doctor sitting in the 5th floor, which floor there is no lift or lift is not working, and poor patient is coming from the ground floor by walking, and you are checking the BP, and there is 180. Immediately you are calling to the ICU, so please admit him in the ICU. That is medical science. According to medical science, okay, but you have to apply your common sense. What he is, why this BP is 180 or 190? What is the reason? How long it is so? What is the past history? Everything you have to take into consideration. Same thing is applicable here. You may be a rich doctor knowing all the medicinal guidelines. Okay, anatomy may be better knowing it, but while applying that, you should know about the client. You should know about the patient. What he is, why, what's the reason? Same logic here applicable. Simply you take a company and there is 1 crore extra he borrowed. Simply you cannot write a specification or a recommendation or inference. This company is going to insolvent. But theory says like that. But he is able to manage. He is able to walk from the ground floor to 8th floor or 5th floor. He came there, asked him to sit down for some time, let him take rest, then you have to measure. If that time also it is like that, then you have to take a decision. You have to recommend him to take some course of actions. So same logic is here. Ratios are not an end. Ratios are mean to an end. It's a mean. It's a way to reach a place. It is not a place where you want to reach. I don't know how many of you are understanding. Don't take a decision just based on the number, just based on that number. Standard is there, actual is there. So standard and actual is not matching. So immediately I'll recommend some corrective actions. You can do so, but after doing some more talking to that particular company, why it is so. Okay. Further, it can increase the debt to another 50 crore. It is able to manage. Okay. Another company is having only less amount of debt, it may go to bankrupt because their operations are very, very poor. Within 2 years, all the capitals are eroded, no earnings. Okay, only payment of interest, everything is going from capital. So they are insolvent. So that point you have to keep in mind. Ratios are giving a guidelines, guiding element, but it is not a final one. You have to take a call and it is you to discuss and decide. Then you have to give an inference. Okay. Next, solvency. Last one is efficiency. What is efficiency? How well I am managing my all operations. Sales department, production department, then marketing, finance department, all these things. Efficiency. How all variables are connected to sales. Okay, total receivables. How much is the sales? For a sale of 100 rupee, what is the receivable? For a purchase of 100 rupee, what is the payables? How many days I'm taking to recollect my amount from the debtors? How many days I am taking to repay the trade payables to the suppliers? So all these things are measured in efficiency ratios. So these are the ratios we are going to check, we are going to discuss today. There are so many theories further to this, connected to this. Okay, you can read this particular document which is there in the LMS already. Okay, advantages, disadvantages, then the limitation. Just now I told you one limitation. Limitation means it's just talking about standard. It does not take into consideration of qualitative aspects of a company, only quantitative aspects. Okay, suppose there is a plant shutdown. In that particular year, my profit has come down. Okay, simply I can compare that profitability of another company. Your competitor company has earned 20% profit, but you have only earned 15% profit. So there is a problem. Please go and check it. If I say that is idiotic, because there is a plant shutdown for 3 months, or entirely my business is in Karnataka, my competitor business is in Tamil Nadu. The locational advantage and disadvantage may be different from each other. So immediately you cannot come to a conclusion. You have to check for the qualitative aspect also. Okay. So that's a limitation of ratio analysis. Okay, let us come to the ratios. Okay, type of ratios. We have 4 types. Just now we discussed 4 aspects. Based on that 4 aspects, we are classifying the ratios also into 4. Any ratios which are helping us to understand what is the profit earning capacity of the company, we call them as profitability ratios, group of ratios. Okay, similar to that, any ratios which are helping us to understand the repayment capacity of the company in the short term, that is being measured in liquidity ratios. Then long-term solvency, debt and equity. How much I own? How much is the owned capital? How much is the borrowed capital? Okay, the relationship between these two and the effects of these two in the operations of the company will be measured in some of the ratios. Those ratios are called as solvency ratios. Profitability, solvency, liquidity, and then efficiency. How the company are efficient in managing the payment receipt with respect to sales. how the inventory is turning over into sales, how quickly the inventory is becoming sales. Okay, those things are calculated in some group of ratios. Those ratios are called as efficiency ratios. We'll see one by one. Apart from this classification, same ratios, whatever is there in this group, these are all group of ratios, group family of ratios. Okay, same ratios may be coming under different category if you go with different classification. We have three more category. Three more means three other category. That means balance sheet ratios, profit and loss account ratios, combined ratios. Any one ratio which is from liquidity can also be called as balance sheet ratio, because data you are taking only from balance sheet. If you take data only from balance sheet to calculate a particular ratio, that ratio can be grouped under balance sheet ratios. If the data is taken from profit and loss account, that ratio can be called as P&L account ratios. To calculate one ratio, one variable I'm taking from P&L account, another variable I'm taking from balance sheet. That time it's called as. That's it. That classification is not making sense. This classification is making more sense with respect to the analysis. So we follow this. Okay, we'll take one by one all these ratios. Any doubt up to this? Are you okay? Those who are online, they're listening. Even I find somebody who are in offline also feeling little sleepy. Yes? No.
We can hear you, sir.
Yes. Okay. Thank you. Next. Yeah. First, we can go with liquidity ratios. Liquidity ratios. A group of ratios I just have told you. It's a mathematics, pure mathematics. That's it. Only division. We are going to study about only divisions. A by B. That's all. What is that A? What is that B? We have to understand. The result, what I can interpret. How do I interpret that result? Only that thing I have to understand. Okay. So first ratio under liquidity ratio is current ratio. Current ratio. So what is current ratio? How do I calculate and what does it signify? What does it tell to me? Current ratio is nothing but the proportion of current assets to the current liabilities. Proportion of current assets to the current liabilities. What is current asset and what is current liability? What is the meaning? Very first class we discussed about asset, right? Under the accounting equation concept, I was talking about the asset, current asset. Yeah, anybody? What is current asset? What is current asset? Any asset which can be changing, which will change its position from one form to another by virtue of the business, by nature of the business, within one accounting period, within short span of time, maximum 12 months. Example for current assets. Sorry, sir. Capital. Capital is asset first of all. Sorry. Is equal to capital plus liability is equal to assets. We are talking about now asset. That too only current asset. Machine is a current asset, sir? No. Machine is an asset. Cash in hand, cash at the bank, advances you received. Advances you received as an asset. Advances you received from whom? Employee. You have to give advance to your employee. What, man, after Corona also you are asking money from employee means poor employees, what they will do? Huh? Advances given to employee is current asset. That's what I'm trying to say. Yes. Current asset. Anything else? Yeah, inventory. Finished goods. All goods. Stock. Inventory. Work in progress. Finished goods. Raw material. Stock in trade. All the four are inventories coming under current asset. Okay. Then prepaid expenses. All prepaid expenses. All prepaid expenses. Okay. Someone is from online trying to say something.
That's not same. Prepaid expenses, I said.
Okay, somebody told here also. Okay, right. Prepaid expenses. Good. Apart from that, which one, sir?
Marketable securities.
Marketable securities. Good. Marketable securities. Short-term investments. Anything else? Okay, cash in hand, cash at the bank, debtors, stock, prepaid expenses, advances, short-term investment. That's stock I told. Interchangeably you can use stock or inventory. So all these things are current assets. Where you can find the current value of current assets? Suppose you want to calculate the current ratio of a company. I want current asset, total of current assets. What's the formula written here? Current ratio is equal to current asset divided by current liabilities. Okay, I know current assets. Where do I know the value of current assets? How do I know the value of current assets? Companies? Financial statement. Ledger, no ledger. Ledger is not a public document. Ledger is a internal records. So how do I know? From the balance sheet. Asset side. Asset side, there will be one heading, current assets. Under that, whatever is there, you take it. Then what is current liability? Any liability which need to be settled off within a maximum of one accounting year. Short span of time. That is called current liabilities. Example for current liabilities: salary to employees and liability. No. Doubt. Sorry, are you really accounting teacher? Asking me. Salary to employee is not a current liability. I'm not even accepting that's a liability. Then only you can classify that as a current or non-current. I don't accept salary as a liability. Will you agree with me? Sorry, if you say what is another go, you have to accept only. Salary is an expense, gentlemen. Salary is an expense. Up to the date of salary is not a liability. After the date of salary, if the company did not pay the salary, then salary becomes outstanding salary. That is a liability. Salary paid is not liability. Salary paid is an expense. Suppose every month 30th is a due date for your salary. 10th April, you did not receive any salary of the March month. Then for the company, it is outstanding salary. It is called liability, current liability. Okay. Anything else? Bank overdraft. Short-term borrowings from a bank or anybody, any financial institution. Sundry creditors, vendors. Sundry creditors are trade payables or accounts payables. Okay, then income received in advance. Somebody told no, receiving money from employees. If it is some company doing, that is called current liability. Normally, what we will do, we will receive from customer. Advance payment you pay, then only I will deliver the commodities. That time it is called current liability. Then what else? That's all. I repeat again: bank overdraft, short-term borrowings, okay, trade payables, sundry creditors, bills payable, accounts payable, outstanding expenses, income received in advance from customers. These 8 are the common typical example for current liabilities. Same balance sheet, I can find these in the liability side. I have to take total the assets, compare these two in the formula, you will get the current ratio. So what is the purpose? Suppose current asset of a company, look at this example. In this company, the current asset of the company is, look at this example. Yeah, current asset is 1,34,000. Current liability is 1,04,000. So answer is 1.29 is to 1. 1.29 times of current assets representing 1 times of current liability in this company. What does it signify? What does it tell to me? What is the interpretation from that 1.29 is to 1? That's the answer, right? Sorry? Assets are more than liability. 1.29 times more than that of liabilities. That is mathematics. What is accounting? In accounting way of telling. Yes, you are right, but little more. Okay, how much it can be? Accounting says 2 is to 1. 2 is to 1. 2 times of liability, asset can be backing 1 times of liability. Why it is so? More conservative. If anything goes wrong, I'm safe by 100%. I'm liable to pay only 1 rupee, but I'm having convertibility for 2 rupees. At any given point in time, I can convert, I can easily create 2 rupees within no time. Within easy time, I can create 2 rupees, but my due is only 1 rupee. So even though there is extreme situation also, I will be safe. So 2:1. I'm solvent in short term. 2:1. Suppose if it is more than that, 3:1 is there for some company. This company 1.39:1. Some other company 3:1. 3 times of assets, 1 time of liability. What is your interpretation now? We have to come to college by 9:30, but this gentleman is coming to the college by 6:30 only. Good, but people are laughing. 3:1 is like that. College time is 9:30, but this person is coming by 6:30. Maybe he is from a village. In his village, only one bus is available, 5 o'clock. He is getting the bus and reaching here 6:30. That's all over. I told you already, no? 2:1 is a BP level is 70 something 90 to 120. Immediately you should not tell him, no, you are wrong. You have to ask him, why did you come by 6:30? Sir, I have only one bus in my village that comes by 5 o'clock. I got into that, reached here 6:30. This time what will do? You can't say that you are very early. You can't say, no. The reason is there. Come back. Now 3:1. So what is the wrong? Suppose he is having a bus, he is having everything, he is normal. But he's, in spite of that, is coming by 6:30. What definitely will laugh. He is having some other reason. Maybe somebody is coming by 6:30. That reason may be there. Why? Maybe. Come to accounting. What is the interpretation will give? Everything is normal. Everything is okay. Okay. That time also the company is having 3:1 means you have to give a prescription. Sir, you are wasting your asset time. I'm utilizing my time. Okay, you are wasting your resources by investing more than what is required in current asset. You are locking up so much of money in the current asset which is not required. Why don't you look into this? Why don't you reduce your current asset? Suppose stock you are keeping excess. What is the effect of keeping excess stock? Profitability will come down. With the help of 1,000 rupees stock, you are able to manage 1 lakh rupees of sales in a year. 1,000 rupees, the average stock you are keeping all the time in the inventory. But you are able to manage the total sales of 1 lakh. That is good. If you are able to do that, but you are not doing that, you are keeping 10,000 rupees of stock. If it is 10,000 rupees of stock, what will happen to this ratio? The current asset ratio will go more. Go upper side, 3. So you have to reduce some of the current assets. Or unnecessarily you are keeping cash in hand. Unnecessarily you are keeping some bank balances. So these are all the reasons. You have to think in this way. Okay. Suppose another company is having 0.5:1. 9:30 class. He's coming by 11:30. I'm checking. Is the break time now? Like that. He's checking. What is the problem here now? What's the problem? You are exposed to you are exposed to illiquidity. Short term. You have to cut a sorry figure in front of your landlord. Sorry, we don't have money. Next week we will pay the rent. Bank will send a notice. Interest is overdue. You will tell the postman, don't deliver the letter to me. Like that, this kind of activities you have to involve. You have to switch off your phone. You have to go for flight mode. Okay. So many things are there. Illiquidity. Problem is, point is illiquid. You are going into risk of illiquidity. Your credit worthiness will get affected. So you have to give that. You have to tell that company, sir, you have to check for your current assets. Why don't you increase some value of current assets? Invest some amount in current assets. That you have to give. Okay. But problem is, whenever you borrow something for your liquid cash, liability also increases. So 0.5:1 is the present situation. You want to improve your liquidity position, means what will happen? You have to borrow money. If you borrow money, liabilities are also it is increasing, assets are also increasing. So ratio remains same. Same quantum will be there. What to do? We have to liquidate some liability and you have to get back. You have to go and approach your creditor who is having a due. Sir, please, my liquidity position is little problematic. Why don't you pay? Okay, you have to ask them to pay. Outstanding liability, you have to settle it. So if you're generating cash from external person without affecting your liability increasing, that time your liquidity position is enhancing. Okay, so that kind of interpretation you have to keep in mind. So the normal range is 2:1. More than this also not good, less than this also not good, but you should not go with an individual idea. 2:1 is not there. Just measuring 2:1, you are having more than 2:1. Simply you cannot give a example. Just now I told you some colloquial examples. Come to the next one, quick ratio. It is little more stringent in measurement. Liquidity in first case, we were little generous enough. We included prepaid expenses in current assets. Can you go and ask the BESCOM if you paid a excess bill, sir, give back, my liquidity position is little problematic. Give back the amount. Once paid is paid. Prepaid mobile recharge you're doing for 1,200 rupees for your employees. 100 employees are there, 1,200 per year. You are charging it. Next month you are having a liquidity crunch. You are asking your employees, please dissolve that mobile charges, go and surrender the talk time, get back the money. Is it possible? Not possible. So we are going little more stringent way of measuring your liquidity, which is really possible that you are taking into consideration, which is not possible we are excluding from the assets. Am I making sense? So two things are there. One is prepaid expenses. Another one is inventory. These two you are excluding from the assets. They are assets. They are current assets. Accordingly, they are current assets, but they can't be liquidated as others can be liquidated. Cash in hand, cash at bank is real liquid assets. Debtors are there. You can make a call and you can request him to pay. But this BESCOM, a best example, which you paid 12,000 rupees, you paid instead of 1,200. By mistake in PhonePe, you put one more zero. Okay, without going to the direct bill payment, you typing it. 1 0 extra. Later on, you come to know 12,000 I paid. What they will tell? They will tell you, no problem, sir. Utilize our service for the next 12 months. 1,000 rupees you minus. Don't pay for the next 12 months. That's impossible. We cannot get back the money. So we are excluding those two things from the current asset. If we exclude these two things, one is inventory, another one is prepaid expenses, we call that as quick assets. Quick assets. So quick asset divided by current liability is equal to quick ratio, or it can be called as acid test ratio. Normally what will happen, the liquidity position through this ratio will be little lesser than that of the liquidity position of the current ratio, because that is generous measurement. This is little stringent measurement. Okay, only that difference. So that is why it is called acid test ratio. Acid test ratio. So current asset minus prepaid expenses and inventory divided by current liability is equal to quick ratio. Okay. Quick ratio need to be 1:1. So what is understanding here? Your prepaid expenses and inventory can be 2 times, can be equal to just current liability. Previously 2:1. Now it is 1:1. From the 2, if you minus 1, it becomes 1:1. So 1 time of your current liability can be in the form of prepaid expenses and inventory. Then only it will be like this 1:1. Suppose out of your total current asset, 70% is the prepaid expense and inventory, means you cannot get 1:1. You will get less than 1:1. Okay, that's the logic. Next. This numbers, you can do it later, no? Answer is there, question is there, logic you know. So I'm skipping that. Okay. Next, second category, that is solvency ratios. First category only we have 2. One is current ratio, another one is quick ratio. Second category now, it is about solvency ratios. Solvency. There are group of ratios under solvency ratios. One is debt equity. What is debt? What is debt? Sorry? Borrowed. The loan, what you taken? Borrowed money. It's called debt. Equity means equity refers to capital, owner's capital. Okay, equity, owner's capital. So the relationship between these two is called as debt to equity ratio. Where you can find the value for these two? What is the formula here? Debt to equity ratio is equal to debt by equity. Debt by equity. Where you can find the value of these two? Where you can find the value of these two of a company? Debt of a company and equity of a company. Please answer me. Only we have two. What's the input for these? From which I can prepare all these ratios? Suppose I want to know all these ratios of a company means the base is profit and loss account and the balance sheet. Without these two, I can't do anything here. That's why the title itself is financial statement analysis. So where you can find this value of these two, debt and equity? Balance sheet. That's it. Okay. Shareholder, just I was telling equity always, but it is written here shareholder fund. There is two ways of doing it. Equity, some people tell only owners fund. Some of the company, there will be preference shareholder. So we include them also for this calculation as owner only. For this calculation, actually they are not owners, but for this calculation, we'll take them also into this calculation called equity. That's why they written shareholder fund. Shareholder fund refers to equity shareholder fund plus preference shareholders fund together. That means long-term debt, long-term borrowings. Okay. So this is called debt equity ratio. The safe level of debt equity ratio is 2:1. Already I told about this. Okay. 2 times of debt can be there in a company in comparison to 1 time of shareholder fund. That's why I told an example now. 50 crore is my shareholder fund, means equity, means one fund. I can borrow up to, if 50 crore is my own capital in a company, I can borrow up to 100 crores. In general. Okay. But it depends upon the company to company. Sir, I am ready to take risk. Who are you to tell? No, it's okay. Go. Going 120 in the road is risky. You are telling not permissible. It's permissible. You can go even 1,000 also, but it is your choice. The flavor is there. Just a flavor is there. 120. There are some signboards are there. 100 is the maximum. 80 is the maximum. Boards are there, but companies are not following that. No, companies are, the speedometer is up to 400. Some bikes are having up to 400. You can go, but it is risky. That's all. Sir, I know when to apply brake. I know where the bend is there. I know where the speed breaker is there. I know when I have to. That time also, it's your choice. It's your choice. So 1:2. 1 time of equity, 2 time of debt. But sometime, if you're having less, 80 kilometers speed in nice road. Okay, nice road, 80 kilometers. I will be always saying one new car, elbowed car, that the lady will go only in 20 or 25. The problem is for whom? Both. See, that time also she will come only in the not center. The bike riding lane will be there. No, bike lane she will be going because she's very much upright. So that time problem. Bike also cannot go, or bike has to come in the car lane, and so many problem will be there. So I have less borrowed money. That means I don't want to take even risk. I will always apply the brake. I don't touch the accelerator. That time, the essence of running a company is lost. So the ships are made only for sailing in the sea. If you keep the ship always in this seashore, then there is no purpose of making a hull or the ship. Okay, there's no purpose. So we have to take risk, but how much? If a company is having a ratio like this, debt equity ratio is not 1:2 or 2:1. They are having lesser borrowed money. I have invested 1 crore, I borrowed only 10 lakhs. So you are not utilizing your capacity of borrowing. You are having capacity. And one more chance may be there, sir. I don't have anything to do further. I am enough. I'm contented in my business. I don't want to take further risk. That's okay. So both sides you have to think and you have to give interpretation. So 2:1 debt equity ratio is the relationship between the owner's capital, that is equity capital and borrowed capital. It need to be 2:1. More than that and less than that need to be given some attention. Okay. So what is shareholder fund? I just explained to you, that is there here. Shareholder fund is nothing but share capital plus reserves and surplus. Okay. Plus preference capital. Okay. Debt capital is nothing but long-term borrowings, loan from banks, debentures, loan from any other financial institutions. Look at this question. This question is having equity, sorry, debt and equity. Look at this in this particular balance sheet. What is the share capital? 12 lakhs. Resource or surplus 2 lakhs. Money received against share warranties 1 lakh. So total put together is 15 lakh is the shareholder fund. They themselves is given in the balance sheet. Shareholder fund is 15 lakhs. So what is the long-term borrowings? Long-term debt. This is what this. Look at this point number 2. The heading itself is non-current. Non-current liability means long-term liability. So total of this, how much? 5 lakhs. So come to the answer. Yeah, 5 lakhs divided by 15 lakhs. Answer is equal to 0.33:1. So what is your interpretation for this company based on the debt equity ratio? Not utilizing the capacity of borrowing. It is not trading on equity. It is trying to play more safe, but more safe leads to less performance. If you go in 80 at least, then only you can reach a place. The purpose of the nice road will serve only when if you go at least by 80. If you don't go by 80, you can go by this road only. Okay, you can go through city. You need not go to nice road. So that basic point you have to keep in understanding. Okay, so 0.3:1. Next, please go through this question later when the class is over. This file is with you. You can just go through all these questions. Okay, next is debt to capital employed ratio. One word we are changing. Previously debt to equity, now it is debt to capital employed. Same logic. Instead of equity, we take capital employed. What is capital employed, sir? Shareholder fund plus debt is equal to capital employed. Previously it was A by B. Now it is A by B plus A. I'm making sense? Previous formula A by B. Now this formula is A divided by B plus A. What is B plus A? Shareholder fund plus debt. Okay. So debt to capital employed. Capital employed includes the own capital employed plus borrowed capital employed. Both the capital put together only we are doing a business. That's why debt to capital employed. What is the relationship between debt and the total capital employed? Long-term debt divided by capital employed. Otherwise, you can call it as net asset. Okay. So the formula is total debts divided by total assets. Debt to capital employed. Total asset means nothing but shareholder fund plus borrowed fund. Total asset. Okay. Next, very, very important ratio is this proprietary ratio under solvency. Proprietary ratio is very, very important. It measures the relationship between shareholder fund and total capital employed. Shareholder fund and total capital employed. Okay, normally it can be 1:1. 1:1. Okay, next. Total asset to debt. Total asset. What's the proportion of debt in the total asset? I have 100 rupee as asset. Out of that 100 rupee asset, how much I have borrowed and made asset? Okay. Total asset to debt ratio. Formula is equal to total asset divided by long-term debt. Long-term debt. Total assets divided by, what is total asset? The balance sheet you can have total asset. Current asset and non-current asset. Total asset divided by long-term debts. In this company, it is 14 lakhs divided by 1 lakh 50, 1 lakh 50,000. So answer is equal to 9.33 is to 1. What do you mean by 9.3 is to 1? 1 rupee is used as a debt amount or borrowed amount to make the total asset of 9.33 rupees. The total value of the asset is 9 rupee, but out of that 9 rupee, I borrowed only 1 rupee from outsider and I contributed to my asset. Okay, so it is more safe. This company, even though the company is having a lot of problem, it cannot be having any issues of insolvency. Okay. Okay. This is the last ratio under the solvency ratio. It measures the relationship between the amount what you are generating out of your business as profit before interest and tax towards the or with relation to the interest payable on your borrowings. Suppose every year fixed charge, interest is fixed, right? If you're borrowing a loan, you have to pay interest. You can't say, sir, there is a pandemic or there is no power or there is no raw material. You can't say anything. It's a legal obligation. You are not giving any ownership to them. You are giving only contract, financial contract. That's all. 100 rupee, what's the interest? 10% interest. I will have to pay 10 rupee out of 100 rupee borrowed every year, irrespective of your performance. Will you agree? Yes, sir, I borrowed a loan from you. I joined for an MBA, but all the subject I failed. I could not pass also. I could not get a job, so I will not pay you interest. If you say that, bank will not accept. Okay, bank will ask another question. Another person has taken a loan from us, 10 lakh. He passed all the subject out of 90%. 90% he got. He got a good job in good company. He's got 20 lakhs per annum as package, but he's also giving only 10,000 as interest. He's not going to give more. So performance and payment of interest does not have any correlation. Whether you are earning money or not earning, you have to pay interest. So that interest, how much you have to pay out of your loan, how much you are able to generate from your business as profit, that both are compared to each other. 50,000 rupees the interest. I am regularly earning a profit of 1 lakh. Then I am safe. Out of my profit of 1 lakh, I can give only 50,000 rupees to the bank as interest. Remaining 50 goes to whom? Remaining 50,000 of profit goes to shareholder. So they are safe. Payment of interest out of profit is okay. Payment of interest out of capital is very, very bad. So I've taken a loan. Even you take an example of individual case. Financial management of a normal company and a normal person, both are similar to each other. Volume may be different. Okay, but basic logic is the same. I'm taking a loan from my friend. I'm paying the interest from another loan taken from another friend. How long it will go? It will go for some years. Sri Lanka, best example today, our neighbor. Okay, people are attributing the reasons for so many things. So many people are attributing so many reasons based on their own interpretation. But basic logic is, if you're not generating anything, you can't live. You have to live on something what you're generating. Suppose you may be having 100 crores of property. You don't generate anything out of that. Every time you are eating from that only, then fine morning, or you are maybe your next generation may not be having anything to sell off. India is also doing the same thing. Days are not too far. If same thing is continuing, it's not my opinion. Some people are writing based on their own political will and everything. They are writing it. Okay. Rahul Gandhi also telling. Okay. Yesterday, Sri Lanka, today, Pakistan, tomorrow, maybe India. Like that is, that's political comment. But we can't ignore the basic fact in that. Borrowing is good. Just now we discussed. A company is having 1 crore capital of its own, can borrow up to 2 crores. Yes, good. But how to pay off the interest on the borrowings? You have to generate something. Out of that, you have to pay interest. And you have to keep something, accumulate it. You have to pay off the principal also later days. So that is possible. That is what real business, or that's what real development for an individual also. So same logic here. You have to calculate this interest coverage ratio, net profit before interest and tax divided by interest on long-term securities, interest on fixed income bearing securities. So this is not a line, this is a division. Okay, this is a division. Net profit before interest and tax divided by interest on long-term borrowings. At least it should be equal to, the answer should be equal to minimum 1. Suppose 5,000 rupees denominator, 5,000 is a numerator. What's the answer? 1. That, I mean, interest coverage ratio is equal to 1. Suppose take another example. 5,000 is the net profit before interest and tax. Interest payable is 10,000. What's the answer now? 5 by 10 is equal to 5,000 divided by 10,000 is equal to 0.5. 0.5. So it is not good for the company because it's not able to generate at least profit equal to payment of interest. It is generating the profit lesser than that of interest. So all your profit generated is eaten away by the borrower. I mean the lender. They have taken it. You don't have anything to serve your shareholder or even to generate some amount for repayment of principal later. Okay. So at least minimum 1. More than 1 is okay. Higher this interest coverage ratio, better the company. Okay. Next. Okay, we have done with the 2 basic. I mean 2 or 3. 2. One is solvency, another one is liquidity. Third one is profit activity ratio or efficiency ratio. Activity or efficiency or turnover ratio. So up to now, no doubt. In morning class, we had a lot of doubts. Anybody? Somebody is working in some company, they connect with these ratios with their company and they ask some questions. I feel we are having 5 more. I mean, we are going ahead of 5 minutes. Actually, up to this, I planned for break, but we have 5 more minutes. If you have any doubt, you ask. There's something we can discuss after the break. 2 plus 2, 2 ratios over, 2 ratios are there. Any doubt? Anybody? Those are online. All are based on formulas. Okay, but you have to know what is it. Okay, simply remembering a formula is difficult, but you should understand what that concept is and you can remember the formula. Okay, I'll give a simple example, simple question. You try this question, then we can go for a break. We have studied about current ratio, no? It's a challenge for your mathematics, not for accounting. Simple question, that is current ratio is given to you and quick ratio is given to you. You are asked to calculate the current assets and current liabilities. Yeah. Can you do this? 4th question. Who is going to do first and right will get 2 marks extra in the assignment. Your time starts now. 5 minutes. Those are online. Take a paper and pen and solve this question. It's a challenge for your mathematics, that's all. Nothing about accounting. Connected to accounting, that's all. Purely it's mathematics. X Limited has a current ratio of 3.5:1 and quick ratio of 2:1. If excess of current assets over quick asset is only represented by inventories that is worth rupees 24,000, meaning this company does not have any prepaid expenses. It has only which one? Inventory. Okay. And then you are asked to calculate current assets and current liabilities. So how do you solve this? Take 3 to 4 minutes time. Try to solve this. And who is telling first, very first, will get 2 marks extra in the assignment. Suppose you get 30 out of 30, you will get 2 marks in your final exam. Okay, solve it. Sorry, sir. Oh, more mathematicians are here. Current liability is 12,000. Okay. So who is first now? That person is first? He is first. But if it's correct or not, you have to check it. Okay. Yes, sir. Current asset is 54,000. If first one is correct, next one is 54. Because 3.5 is already given there. 3.5 times of 1, that is current liability. Okay, what's the answer? Is it so correct? Anybody has a different answer? It's a simple mathematics. So current asset is 56. Current liability is 16. How much you told? 12. What is the wrong? So no, the question is solved. I mean, wrongly. So the offer is withdrawn. Now, answer is here. Quick ratio. Look at this. Current ratio is 3.5 is to 1. Quick ratio is 2 is to 1. Okay. So the difference between these two is 1.5. That 1.5 is equal to what? Quick assets. Okay, let it be. Now you take current liability as X and we are solving it. The difference between these two is 1.5x. Okay, that 1.5x nothing but you have to calculate here. So current liability is equal to 16,000. Why it is 16,000? 24,000 is the 24,000 is what? Inventory. So 1.5 x is equal to 24,000. So x is equal to 24,000 divided by 1.5 is equal to 16,000. Same logic you applied, different logic you applied. Okay. So it is equal to 56,000 and then, sorry, 32,000 and 16,000 is the current liability. Quick asset is 32,000. Okay. 2 is to 1, no? 2 is to 1, 2 times of liability. So it is 32,000 is the quick asset. 56 is the current asset. What is the difference between these two? 56 and 32 is the difference is how much? 24. The 24 is the. So this is testing your mathematical understanding, connection between one variable to another variable like that. Okay, normally this is not used in our analysis, but in academics we will try to give this kind of question also to check your deeper understanding on the ratios. Okay, normally what you will do in a company will not give you the ratios. You have to calculate the ratios for the company. For the ratios, we are giving interpretation. But this is to test your deeper understanding on ratios. If you do not know what is current ratio and quick ratio, you can't do this. That's why. Okay. Look at this question. Calculate the current ratio from the following information given to you. Total asset is 3 lakhs. Non-current liability is 80,000. Shareholder fund is 2 lakhs. Non-current asset is equal to, that is fixed asset 1 lakh 60. Non-current investment is 1 lakh. Can you calculate the current ratio? Sir, if you want to calculate the current ratio, please give me the current asset and current liability. Is there anything here? Total asset is there. Non-current liability is there. Okay, find out the current ratio. For this, 1 mark. Only 1 mark. A little easy, no? Already somebody told the logic, so that's why. Only 1 mark. If anybody does it correctly, 1 mark you will get for in assignment addition. First, quickly. Fixed asset plus current asset is equal to total asset. Total asset is equal to, in a balance sheet, total asset is equal to, again, don't tell the same equation again. Fixed asset is equal to, total asset is equal to liability plus equity. Liability plus equity. Shareholder fund plus borrowings. That logic you would apply here. Total asset is 3 lakhs. Non-current liability is 80,000. Shareholder fund is 2 lakhs. Non-current asset is 2 lakh 60. In that also fixed asset is given separately 1 lakh 60. So what is the current ratio now? Current ratio? Anybody found out?
Current assets divided
sir?
by current liability.
What is the ratio?
Okay.
Come
I'm
again.
telling the formula actually.
Okay, formula is equal to current asset by current liability.
Yeah.
Yeah. Tell me the answer. Somebody find out the answer. 9.5:1. 0.25:1. Okay, so many ratios, so many answers. It's simple. How much? 2:1.
2:1.
Total asset should be equal to always fixed asset plus current asset. That's what written in the first sentence. Look at the first sentence. Total asset is nothing but current asset plus non-current asset. Total asset is given the question as total asset how much? 3 lakhs. That 3 lakhs should be
3 lakhs.
equal to non-current plus current. Non-current is given. What is non-current? 160. 1,60,000 is given. So 1,60,000, if you take it out, no, sorry, non-current is how much? Total non-current is 2,60,000, no? 2,60,000. Non-current, this is heading, non-current asset. So 2,60,000. 2,60,000 minus from 3 lakh is equal to only 40,000. That 40,000 is going to be current assets. How
Current
many of you
assets.
found out current asset rightly? Current asset. It's simple. 40,000. Okay. After that, we need what? Current liability. Current liability. How do you find current liability? Total assets should be equal to shareholder
3
fund
lakh.
plus long-term liability plus current liability. Shareholder fund already given the question 2 lakh. Non-current liability given the question as 80,000. That should be equal to total assets plus current liability. So current liability can be calculated minusing these two from 3 lakhs. So 3 lakhs minus 2,80,000 is equal to 20,000.
20.
So 40 by 20 is equal to
2:1.
Most of the time, this kind of data we will not give you, but sometime possible. In companies, we don't find this kind of data. Companies, we have direct data. Current asset will be there. Current liability will be there. Easily we can find it out. That's what your assignment. But in exam, we may be giving you like this to test how do you connect and find out the missing figure. Okay, and then finding out the ratios. Okay. Yes, madam, any doubt? Anybody has any doubt? Okay, we can pause for 10 minutes. Take a break. We can come back after the break. We'll continue with the 2 more group of ratios. Thank you. See you after 10 minutes. Okay, break is over now. Can we start? Yes, the another 2 ratios you have to finish. The third group of ratios is efficiency ratio or activity ratio or turnover ratio. Online people, I'm audible to you?
Yes, sir.
Thank you. The very first ratio under the activity ratio is inventory turnover ratio. We are comparing the inventory with turnover. Turnover here refers to sales. Okay, how quickly you are able to convert your inventory into sales. That is being measured in this particular ratio called inventory turnover ratio. So the formula to calculate inventory turnover ratio is average inventory and sales. You are comparing the average inventory with the turnover. Turnover means sales, net sales. The formula is net sales divided by average inventory or cost of revenue from operation. If you don't have sales, you can take cost of sales. If you have sales, don't have profit or cost of sales, you can directly take sales. Okay. Suppose 5 rupees is the sales, 1 rupee is profit, the cost of sales will be 4 rupees. So 4 by something or 5 by something will be slightly different in answer. That's okay. Depending upon the data availability, we can take it. Suppose as an outsider, we may not be knowing the cost of sales. In profit and loss account, we may have only sales. So we take sales, no problem. Okay. So sales divided by average inventory. What is average inventory? Opening inventory plus closing inventory divided by 2. What is opening inventory? last year balance sheet, what is the closing inventory? That becomes opening inventory of current year, this year. Okay. Inventory includes work in progress, stock in trade, raw material, finished goods. Depending upon the company, these four. Okay. So what is the interpretation for this ratio? Take an example here. Yeah, we have calculated the inventory turnover ratio. Look at this 3 times. If inventory turnover ratio of company A 3 times, the same of company B is 4 times. So what is your interpretation? 4 times is better. Why, sir? More number of times the stock is becoming sales. Stock is turning over into sales. Okay, look at this. 60 by 20 equal to 3 times. Suppose same company 60,000, but the inventory average inventory is 60,000 again. 60 by 60 is equal to 1. 60,000 by 60,000 is equal to 1. Suppose another case 60,000 divided by 10,000. Answer is 6. Meaning the company is able to manage the 60,000 worth of sales with the help of 10,000 rupees worth of stock. So that is better. Having lesser stock and achieving the same level of sales is good, is better. So higher the number of times of inventory turnover ratio, better the efficiency of the company. Okay. Any doubt in this? Somebody told, sir, when you are teaching in the class, everything is okay, but when you are opening a book, that time only doubt is coming. So think it up. If any doubt is there, you can clarify right now. You are going to do it for practical for 2 companies now, so you have to be a little more alert and you have to understand what it is. This value is nothing but the sales or cost of sales. It's nothing but the balance sheet inventory values of average. Next. Trade receivables turnover ratio. Trade receivables turnover. What is trade receivable? The accounts receivable. How the relationship between the accounts receivable and sales. That is established in this particular ratio called receivables turnover ratio. The formula to calculate receivable turnover ratio is net credit sales divided by average trade receivables. Net credit sales divided by average trade receivables. What is net credit sale? Total sales minus cash sales minus sales return. Total sales minus cash sales minus sales return. It's called net credit sales. Total sales minus cash sales minus sales return is equal to net sales, net credit sales. That is divided by average trade receivables. Trade receivable includes bills receivable, accounts receivable, sundry debtors, etc. Okay. So opening plus closing of these 3 divided by 2 is equal to average trade receivables. Suppose you are getting an answer. Look at this question. I have some data. Illustration number 15 has some data. Total revenue from operation is 4 lakhs. That means total sales. Cash revenue from operation is 20% of total revenue from operation. Trade receivable as on beginning is 40,000, closing is 1,20,000. So how do you calculate the trade receivable ratio? Can you quickly calculate and tell me? For this question, anybody is not telling the answer correctly, they will be having 2 marks less in your assignment. Revenue from operation 4 lakhs. Cash revenue from operation is 20% of total revenue. Opening balance of trade receivable is 40,000. Closing balance of receivable is 1,20,000. what is the trade receivable turnover ratio? You have another 10 seconds. Sir, 4 times, sir. Okay. So he avoided his minus mark. Others,
What is turning?
every- final answer. 4 times. Others, found out? How do you find it out? 80% of 4 lakh is the net credit sales. No, 3 lakh 20,000 divided by 80,000. 80,000. So what answer is 4 times. 4 times trade receivable ratio. Look at this, trade receivable ratio is this, but there is one more concept called average collection period. What is the ratio you found out now? Just 4 times. Okay, this 4 times means 4 times your receivable is turning, sales turning into receivables. Now, how do you calculate this number of days required to collect money from the debtors? That's what I explained in this formula. That is called receivable collection, debtor collection period. Average receivable period. Debtor collection period. Look at this equation, number of days in a year or month in a year divided by trade receivable ratio. What's the answer we found out? 4 times. 12 months in a year. 12 by 4 is equal to 3 months. 3 months is the average collection period. That means if you sell today, within 3 months as an average, you are collecting back the money. Okay, what is the relationship between that 4 and this 3? If that 4 increases, 4 becomes 6. What will happen here? 12 divided by 6 is equal to 2. So number of times increases, days or month required to collect the debt from the customer is decreasing. So collection period, average collection period should be less and receivable turnover ratio should be more. That indicates the better efficiency of the company. Clear to you? This formula, number of days or months in a year divided by trade receivable ratio, will give you the answer either in days or in months, within which you are able to collect back your money from the customer. Okay. Next, just opposite of this, that is trade payable turnover ratio. Trade payable. How you are paying back to your vendor, that is being captured in this particular ratio called trade payable turnover ratio. So trade payable turnover ratio is equal to net credit purchase divided by average trade payables. Average trade payables. Same logic, average trade payables are nothing but total of opening payables and closing payables divided by 2. Same logic, average payment period is equal to 365 days or 12 months divided by payment payables turnover ratio, divided by payables turnover ratio. Okay. Look at this example. Try this. Try this. Credit purchase of 14/15 is 12 lakhs. Creditors on 14 April 3 lakhs. Bills payable on the beginning is 1 lakh. Creditors at the end 1,30,000. Bills payable at the end is 70,000. Then you calculate the trade payable turnover ratio as well as the average payment period. Average payment period and the trade payable ratio. Formula, you know, net credit purchase divided by average trade payable. Apply the formula, substitute the values. Four time is the trade payable turnover ratio. How do you calculate? See, bills payable and creditor. This is closing. So 1 lakh, 2 lakh 30 is the closing. Sorry, 4 lakh is the opening and 2 lakh is the closing. So 4 plus 2, 6, 6 by 2, 3 lakhs. 3 lakh is the average trade payable. Credit purchase is given 12 lakhs. So 12 by 3 is equal to 4. 12 by 3 is equal to 4. 12 lakhs by 3 lakhs is equal to 4 times. 4 times. So what is the average payment period? 12 divided by 4. That is equal to 3 months, 90 days. Sorry? What means? For the previous. Yeah. It happens like that. In this data, it is coming like that. Okay. Both are having 4 times. So it is going to be 90 days, 3 months. But the interpretation will differ. See here, 4 times. What is the meaning? You are able to manage the purchase of 12 lakh rupee by having an average payables of 3 lakhs. Okay. Suppose your average payable is 4 lakhs means what's the answer? 3 times. So average payable, lesser the number of times, better the efficiency, because it's not efficiency actually. If you're able to get that much of credit period from your supplier, then it's okay. You are purposefully delaying means that disturbs your credit worthiness. They're giving you, you are using it, then it's okay. Okay, number of days also, payment period. What is the average payment period here? 90 days, or you told 3 months. If I am able to enjoy 4 months, if it is 3 times, then answer for payment period will become, if this is 3 times, then number of days will become 120 or 4 months. I'm having, so much of time to pay back my payables. So really it's good. We'll study about that in financial management next semester. How do we manage finance in the subject called corporate finance? Okay. Let us not go beyond this. So this is only calculation of payment period and trade payable turnover ratio. These are all outcome of your financial management policy. Whatever you do in financial management, that is resulting in the transaction. The transaction is captured in the books of accounts, that is coming to us, we are analyzing it. From this, if you know, so this is not correct for my company, I want to increase my number of days within which I have to pay my payables. Then you have to talk to your purchase manager as well as to the finance manager. They have to talk to the vendor. You have to source such a vendor who is giving you extended credit period without compromising in quality as well as price. Some company will give you extended credit 1 month, 1 year also you can take. We don't want to collect back your money, but quality may be deteriorated or their price may be high, inflated price. Next is the 4th group of ratios, that is profitability ratios. Profitability ratios. Are you done with all in the Inventory turnover you done. Trade receivable turnover you done. Investment turnover, fixed asset turnover, working capital turnover. Yeah. Net asset turnover ratio. Before going to the next group, we'll cover this missed out 3-1. Okay, three are there. Okay. So net asset to turnover. Net asset turnover. Net asset and capital employed both are only the same. Net asset or capital employed to turnover. Okay, net asset turnover ratio. Otherwise, you can call it as capital employed turnover ratio. Capital employed turnover ratio. What is net asset? Net asset means the capital employed of the company. Capital employed of the company is called net asset. So the formula to calculate net asset to turnover ratio is revenue from operations, that is sales divided by capital employed. Sales by capital employed. Yes, madam. Anything is wrong here? Formula is wrong. If formula is wrong, you have to ask NCRT, National Council for Educational and Training Research. Yes, madam. Anything? Three of you. Three intelligence. Tell us. No? Something else. Okay, that's okay. If it is something else, that's okay. All right. So this is sales by capital employed. What you will understand from this? Suppose your sales is 10 lakh, capital employed is also 10 lakhs. Answer is 1. What you can understand from that number 1? No profit, no loss. Yes? Huh? No. What you are comparing there? You are comparing the sales with capital employed. You take another example, another company. Sales is 10 crore, capital employed is 1 crore. What is the answer? 10 times. So previous one is answer is 1. Now it is 10. So what is the interpretation you can give? First company is generating revenue only equal to how much is invested. Second company is generating 10 times more than their investment as revenue, not as in profit, as revenue. So what is the velocity of revenue you are generating out of your investment that is being captured in this? So higher the net asset turnover ratio, better the efficiency of the company. Higher the net asset to turnover or capital employed to turnover ratio, better the efficiency of the company. Okay, some variant is there. Just like our delta, here also some variant also. This particular net asset ratio, we can have another type, that is net asset turnover ratio is equal to revenue from operation, that is sales divided by net fixed assets. Okay, here we've taken all the total capital employed. Okay, here it is only net fixed asset. How do you calculate net fixed asset? Total fixed asset minus total fixed asset. Why do you minus current asset? If you minus current, there's no meaning. No, already fixed asset is there. From there, you do minus fixed asset minus fictitious asset or any loss asset or any waste asset that has value in the book but does not have value in the market. Okay, fixed asset, net fixed asset. Okay, next. Second variant in this formula is working capital turnover ratio. Working capital turnover. Net revenue from operation, that means sales, net sales. Net sales means sales minus credit sales. Sorry, sales minus sales return. Sales minus sales return. Sales minus sales return is the net sales. In some place you're using credit sales, some place we're using the net sales. For the collection period or for the trade receivable ratio, we used net credit sales. But here we are using net sales. Net sales include total sales minus sales return. Okay. So working capital turnover ratio is nothing but sales divided by working capital. What is working capital? How do you calculate working capital? Total current asset is called as gross working capital. Current asset minus current liability is called as net working capital, just working capital. Okay. Look at this question. Can you calculate net asset turnover ratio from this question? Net asset turnover ratio. 18th illustration. Calculate net asset turnover, fixed asset turnover, working capital turnover. Can we calculate the first one, net asset turnover ratio? What's the formula for net asset turnover ratio? Yeah. So take the values. Sales given 30 lakhs. Is it correct? In this table, it's not a balance sheet or it is not a income statement. It's the abstract of the statement. Where it is, it's a balance sheet. Preference share, general reserve, balance. Okay. Okay, revenue from operation given separately. It's an abstract of a balance sheet. Abstract of a balance sheet. And revenue is given separately. Look at this 30 lakhs. That is sales. Capital employed. How do you calculate capital employed? Share capital plus reserves and surplus plus long-term debt, long-term borrowings. Okay. So what is given here in the question? Share capital how much? 4 plus 6, 10 lakhs. Equity plus preference. General reserve 1 lakh. P&L account is 3 lakhs. Then long-term debt 2 lakhs. Loan 2 lakhs. So except creditor, bills payable and outstanding. Remaining all come under capital employed. 4 plus 6 plus 1 plus 3 plus 2 plus 2. What's the total? 18 lakh is the total capital employed. Fixed asset how much? Plant and machine, land and building, motor car, furniture. It is 10 plus 6, 16 lakhs. Okay. So working capital, current asset minus current liability. Already we have current asset here. These are all current asset. Inventory, debtors, banks, and cash. Okay. So that's equal to 290, 374. 4 lakh is the current asset. Okay. Current liability is 3 items are there. Creditors, bills payable, and outstanding expense. 2 lakhs are there. So 4 minus 2 is equal to 2. 2 lakh is the current working capital. Okay. So why we need working capital? To find out the working capital turnover ratio. Okay. Fine. Now net asset turnover ratio is equal to, already we calculated net asset. How much net asset? 18 lakhs. Okay. So 30 by 18 is equal to 1.67 times. Net asset, fixed asset turnover ratio. Fixed asset is 30 lakhs divided by 16 is equal to 1.88. And working capital we already calculated, that is 2 lakhs. So 30 by 2 is equal to 15 times. So these are all the answer. Finding out answer is easy and it's okay. That's not a great deal. But the thing is, how do we interpret that number? Interpret that number. Okay. How do you interpret here? 1.67 times of net asset turnover ratio. What does it mean? What is the formula for net asset turnover ratio? Sales by net asset. So that gives me 1.67 times. What is the meaning? My assets are 1 means my sales is 1.67 times. So my assets are generating 1.67 times of its value as sales. Suppose my competitor company is there, their net asset turnover ratio is 3. Then something wrong with me. I have to check how they are able to generate 3 times of sales out of 1 asset, 1 rupee of asset. They are able to generate 3 times of sales, 3 rupee of sales. Something wrong with me. So higher the ratio, better the efficiency. Second one, fixed asset turnover ratio. Again the same formula, no? Net asset divided, sorry, net sales divided by fixed asset. That is equal to 1.88. Same logic. That is total asset. Here it is fixed asset, only fixed asset. Next, working capital turnover. With the help of only 2 lakh rupees of working capital, I am able to manage a sale revenue of 30 lakhs. So it's 15 times. If it is increasing, it's good. Again, you have to have a caution there. If it keep on increasing, working capital is reducing, then only the answers can increase. Mathematics, simple mathematics, no? If this denominator is reducing, this answer will be increasing. You know, suppose only 1 lakh, answer is going to be 30 times. It is good. Same logic I'm telling you. Going in a high speed is good to reach the place in time or much before the others are reaching. But that creates, that involves risk of accident. If you have a small disturbance, the effect of the quantum of impact, what you have and another person who is coming slowly and steady, you'll be having more consequence than that of the other gentleman. That's why it is risky. Okay, but how far, how much I can take, that's depending upon the company. Okay. Can we go to the next one? Profitability ratios. Here 10 ratios are listed here. Profitability, the ability of earning profit out of a single rupee of investment, out of a single rupee of sales. All these variety is going to be analyzed in this particular group of ratios called profitability ratios. The financial performance of the company or a business can be summarized by having these profitability ratios. Okay. One more point, if you are free and having some interest in this particular financial statement analysis, you can check with one concept called, we don't have that in our syllabus, DuPont analysis, D-U-P-O-N-T, DuPont analysis. Video will be there in YouTube or any material can be there online. You can check it. All these ratios, now we are having bits and pieces, right? We have discussed, see, Bangalore is having this, that, this, that. I am telling you many things, but I want to see the Bangalore. Show me. You told many things, but put together what is Bangalore? I want to know. One small chart, everything put together. That is called this DuPont analysis. So many ratios we've done so far. We are about to finish now. With this 10, we are going to finish. But I don't know. Suppose a blind man seen an elephant. If you ask what is elephant, he is going to tell so many description. One man may say some concept. It is very big, bulk, or it is tall. Something he is going to tell because he is not able to sense what is an elephant fully. So now that's kind of understanding we are having now. So far, I told you how the leg of an elephant is, how the ear of an elephant is. We all discussed. But how, you want to draw an elephant now. For that, this will help you. DuPont analysis. If you want to say one point, so tell me one. So many points. Okay, the company is good or not, sir? Only tell that. People are not interested in all those things. You are studying, you are learning, but finally, suppose you are going and telling some doctor, no, they will irritate you. They'll think that they are teaching you more. Diabetics, if you go, or any kind of disease, if you go, they'll teach you. You are not going to write an MBBS exam. After all, you are a patient. We want some prescription. Sir, how do I get out of this? How do I get all right? You tell me that. Don't tell me where the coronavirus initiated, started, how it is developed, what are the variant. Do you have injection or not? That tell me that we don't have. Then why are you telling all this story? That kind of world we are now. An investor. He is going to invest. There is one new company coming in. Zomato shares are there in the market. What is the share price of Zomato today? Zomato. We order Zomato. We order food in Zomato, but we don't worry about Zomato. Come and check it. What's the share price? 90 rupees. You are having. You are following Zomato. Okay, 90 rupees. Okay, can I buy it or not? That much you tell me. So today it is selling at 90. You may be good in analysis. You may be good in all these things. You tell me yes or no. For that, this will help you. You have so many 4 categories. Sir, gross profit of Zomato is 20%. Net profit of Zomato is 40%. Sir, finally, what is your conclusion? Tell me the advice of to buy or not to buy. Already I have. Should I sell or hold it? You tell me that. So that kind of analysis you have to reach. That you will study in the later stages when you take finance as your specialization in your later semesters. Keep that in mind and follow this. Next, the first one is gross profit ratio under profitability ratios. Okay, so profitability ratios are going to give you the sum of the financial performance of the company. First one is gross profit ratio. Gross profit ratio is equal to gross profit divided by net sales multiplied by 100. What is gross profit? Gross profit is nothing but net sales minus cost of goods sold is equal to gross profit. In your balance, in your income statement, you don't have any separate line called, category called, or breakup called gross profit. You don't have. Net revenue from operation plus other revenue from other income is equal to total income minus 5-6 expenses is equal to net profit before tax. We don't have gross profit, but it is analysts should calculate what is gross profit. Then you have to compare that gross profit with net sales. Okay, so what is gross profit? Net sales minus cost of goods sold. What is cost of goods sold? Cost of goods sold is nothing but opening stock plus purchases minus purchase return plus expenses on purchase minus closing stock. He's telling, sir, what is this? Plus minus plus minus. Simple logic, sir. Stock plus direct expenses. Cost of purchase plus direct expenses. Put together is cost of sales. Cost of goods sold. I am minusing that from the sales. Sales. Simple. 100 rupee is my selling price. To make that sales of 100 rupee, I spent 40 rupees on purchase and 10 rupee on process. So totally how much I spent? 50 rupees. For how much I sold? 100. What is my profit? This is called gross profit. After that processing, I have so many administrative expenses, marketing expenses, overheads. All those things will be minused from that 50. Assume that is 30 rupees. So 50 minus 30 is equal to 20. The 20 is called as net profit. But net profit will be reported in the financial statement separately in the name of net profit. But GP will not be reported in the financial statements directly. You have to calculate by applying this logic. Okay. So gross profit. Second one is operating ratio. Okay, you want to see the gross profit ratio? Yes. Look at this. Revenue from operation. There are two types: cash and credit. So totally 1 lakh is the sales. Purchase is 75,000. Carriage inward means what? Transportation cost on purchase. Okay, 2,000. And salary 25,000. Decrease in inventory 10,000. Return outwards 2,000. Wage is 5,000. So now we are calculating revenue from operation, that is equal to 1 lakh. Already I told you. Net purchase, total purchase minus sales return. Is there, sorry, purchase return? Any purchase return is there? That's okay. Purchase is okay. 75,000. Carriage inward is a 75 plus 2. 77 should be there. Yeah. Yes, minus.
Return outwards.
But return outward is mentioned here. Yeah, it's here. Sorry, it's there. Yeah, return outward 2,000 is there. That is purchase return. So that's why it's minus 2,000 here. Okay, so 73. Next, cost of revenue from operation. Okay, purchase plus opening stock minus closing stock plus direct expenses. Okay, is equal to 90,000. So 90,000 is minus from the total sales of 1 lakh. So 10,000 is the gross profit. You may ask a question, sir, there are so many expenditure mentioned over there. Why you are not taking that? All those things are not direct expenses. Only direct expenses you have taken. So 10,000 is a gross profit. Out of 1 lakh sales, I am earning a profit of 10,000. So how much is per 100 rupees? 10%. Higher the gross profit ratio, better the efficiency or better the performance of the company. Higher and higher the GP ratio, better the performance of the company. Second one, operating ratio. Operating ratio is about expenditure, operating expense. Okay, operating expense plus cost of goods sold divided by net sales into 100 is equal to operating ratio. Look at this, cost of revenue from operation, what you have done in the previous equation, plus operating expenses. Operating expense means salary, rent, everything put together. Okay. What will not come under operating expense? Donation given to a political party. Now there is a law, right? Anybody can donate money to political party without telling your name. You know that? Yeah. And that is having some tax deduction also. Like that, you can give to donation to anybody, or you are having a habit of helping the poor people in your locality, not as a CSR activity, compulsory activity. You are having an activity like that. You are spending money, 5,000 rupees you are spending. That 5,000 is not an operating expense. Without that also you can do business. Okay. So without that, you have whatever expenses you are adding with the cost of revenue, that's equal to total expenses. Okay. Divided by net sales into 100 is equal to operating ratio. This operating ratio captures the percentage of expenditure to the total sales. So if you're having operating ratio as 80%, another company is having operating ratio as 50%, which is good. First one or second one? 50%, because it's measuring the expenditure cost. So lesser the operating ratio, better the performance of the company. Next one, operating profit ratio. It's very simple. 100 minus operating ratio is equal to operating profit. Sales minus expenditure is equal to profit. Already we have a ratio for us, expenditure. If you minus that ratio of expenditure from the 100, you will get the answer of operating profit ratio. Operating profit ratio formula is equal to 100 minus operating ratio. Otherwise, operating profit divided by net sales into 100. Both will give the same answer. So what is the interpretation here? Operating profit ratio, what's the interpretation? How do you interpret the operating ratio, operating profit ratio? Please help me, somebody. No, that will come simple understanding. So far we are telling higher, lesser, in that manner. In so many ratios, I'm telling from the beginning I was telling. For current ratio, I told 2:1. After that, I told higher the better or lesser the better. More. So higher the ratio, better the performance of the company. Okay. Yeah. Next one, net profit ratio. You will be having a net profit in the company's profit and loss account. You take that and divide that by net sales, multiply the answer whole by 100, you will get net profit ratio. Net profit upon net sales multiplied by 100. You are representing all these ratios in terms of percentage. So what is the interpretation now? Higher the ratio, better the performance of the company. Okay. It's easy, no? Net profit ratio. This will be directly there. Net profit will be directly there. Sales will be directly there. You can just take it and divide it. That's all. Look at this question. Gross profit of a company is 25%. Its credit revenue from operation is 20 lakhs. Cash revenue from operation is 10% of total revenue. If the indirect expense of the company were 50,000, calculate its net profit. So total revenue from operation is how much? 20 lakh from credit revenue. And cash revenue is 10% of the total revenue. So how do you calculate the total revenue of the company? Cash revenue is 20 lakhs. That's just equal to 90%. Okay. Not 90%. Total is 100. 10 is what? Cash. Remaining 90 is credit. That 90 is equal to how much? 20 lakhs. Then how much is equal to 100? How much is equal to 100? That is equal to 2 lakh. Sorry, 2,22,222 is 10%. And that portion of cash sales. So add that to you will get 22 lakhs, 22,222 rupees is the total sales. Okay. Then now we need what? We need net profit. I mean, first gross profit, then you have to minus. Okay, net profit is given, sorry, gross profit is given in the question, that is how much? 25% of sales, 25%. So 25% of total sales is how much? 5,55,555. Okay. From that, you have to minus the other expenses. What expenses is there? 50,000. So if you minus 50,000, it is going to 5,05,555. That is the net profit. You already have total sales. So 5,05,555 divided by 22 lakhs, 22,222 into 100 is equal to net profit ratio. That is equal to 22.75%. See, these are all the tricks that is only you can find in the academic question paper. But in real life, no company will come and tell you, my total sales is unknown. My cash sales is 10% of total sales. My credit sales is only 20 lakhs. It's both things are taught here now in this, through this from a textbook. One is your mathematical ability, another one is the ratio. Thinking, how do you connect? Okay, right. Anyway, in your assignment, you will be having gross profit, sorry, net profit directly in the statement. Okay. Yes. Return on capital employed, ROCE. ROCE, return on capital employed, or you can call it as ROI, return on investment. Very, very widely used term in your newspaper, business line, or any of the business news, NDTV profit, all those things. People talk about this ROI, return on investment. What's the formula? Return upon investment. Simple. What is the formula here written here? Look at this. Profit before interest and tax. The return is nothing but profit before interest and tax divided by capital employed. We ignore here the interest and tax because that is not relating to my operation. I borrowed, I have to pay interest. If I have not borrowed, if it is my own money, I need not to pay interest. So payment of interest is coming later after my performance. That's not my performance. Interest payment, tax payment is not affecting my performance. Actually speaking, my performance is affecting the quantum of payment of tax. If I see how difficult in our country, see, if we perform better, you have to pay more tax. If you are performing better in exam, actually you are getting more mark. But actually speaking, if I perform better, if I'm spending my Sunday here with you to earn some money to support my financial status of my own family, but government is telling you are working on Sunday, okay, give me this much of money. That does not worry, they don't worry about you are working at midnight, you are working at Sunday, or you are working at holiday. They don't know. Are you working? You are earning? Give me this much of money. How much is the tax? Huh? Slab rate is there now. People who are earning like this, very poor. This government does not even bother about us. The slab is not at all increased. For how many years? 6, 7 years, it is not increased. You are increasing the petrol price, you are increasing gas price, you are increasing diesel price. But why don't you increase the tax slab from, where it is 5 lakh? From 2 lakh to at least 5 lakhs? EPWO. What is EPWO? EPC, something is there now. EWC. Economically weaker section. How much is the slab? You are accountingly very strong, but politically very, socially very poor. What is slab they fixed? Or creamy layer, what they fixed for OBC? So you are all private sector people now. You don't worry about. You fix whatever you start. Government, you are having different government. It's parallelly you are having some separate. Okay, but anyway, if I'm remembering correctly, 8 lakh rupees they are fixing. 8 lakh is your income, means you are economically poor. But tax slab is 2.5, means you are rich, you have to pay tax. Okay, I'm just telling my own viewpoint on this. Come back to this return on, yeah, profit before interest and tax. We are ignoring tax. because my performance does not affect payment of tax does not affect my performance. Only it's out of profit, not against profit. Interest is against profit again. Interest is against profit according to accounting term. But choice is yours. Borrowing or not borrowing, choice is yours. Company, finance manager is deciding. That's what we call it as capital structure. How are you going to make up your capital? In my example assignment, I given you your own capital, debenture, as well as equity share capital from public. So all equity become owner's capital, borrowing becomes debt capital. So there itself, I'm telling you the capital structure. Who is going to decide that? The company, the finance manager. Okay, so that is your choice. So because of that is your choice, I'm ignoring the tax, interest also here. Without payment of interest, what is your performance? Out of 100 rupees of investment, what is my earnings? Okay, that's being measured in this ratio called ROI, return on investment. So profit before interest and tax divided by capital employed multiplied by 100. Better the, higher the ROI percentage, better the efficiency of the company. Okay. Next, return on shareholders fund. Here we consider both, because as a shareholder, how much I'm going to get finally from the company after paying the tax, after paying the interest. If my company is having debt capital, how much interest they have to pay, let them pay. After that, what is the tax of that country, of that particular land, I will pay. Remaining is my profit. How do I calculate it? Profit after tax, the bottom line of the P&L account. Profit after tax divided by shareholders fund. You already know what is shareholder fund. We discussed in the solvency ratio. Shareholder fund is equal to share capital plus equity share capital plus reserves and surplus plus preference share capital. Okay. Yeah, this is very, very important. Higher the return on shareholder fund, better the performance of the company. Okay. EPS. Have you heard about EPS? Yes. EPS. What is EPS? Earning per share. What is a profit available to one equity share? Is called as earning per share. Net profit after tax minus preference dividend divided by number of equity shares will give us EPS. How do I find out this number of equity shares in the company? Where do I find this number of shares? I need a denominator, no, number of shares, number of equity shares. Where do I find it? Note number 1, equity share capital will be there. In that note, I will find out. In balance sheet, it won't be there. After the balance sheet, in note, it will be there. Profit after tax will be there in the P&L account. Dividend will be there in the note. Or note number 1 will consist of preference shares also. It will tell about the percentage of dividend. So you have to calculate the percentage of dividend on the face value of preference share. You minus that from the profit after tax. Remaining is called profit available to equity shareholders. That is going to be divided by number of equity share. That is going to give you the earning per share. Suppose net profit after tax is 1 lakh. Okay. Preference capital is 10 lakh. 2%, just assume 2% is the dividend on preference share. 2% on 1 lakh is 2,000. Already 1 lakh profit is there after tax. 1 lakh minus 2,000 is equal to 98,000. That 98,000 should be divided by number of equity share. We don't know what is number of equity share. I did not give you any data. You got to refer the note number 1. From there, you have to take the number of equity share. Suppose assume 10,000 equity shares are there. So 98,000 divided by 10,000 is equal to 9.8 is the EPS, earning per share. What is the interpretation for this? More the amount of EPS, more the value of EPS, better the performance of the. Here, just to give you one small point, we can discuss in the next semester your corporate finance. If number of shares are less, if this denominator is less, what will happen to this answer? It will mathematics, simple mathematics. It will be increasing. 10 by 2 is equal to 5. 10 by 2 is equal to 5. So that relationship, you know, multiplier. Okay. So how can you increase the EPS? If you keep less number of equity share, you can increase the EPS. So if I reduce the number of equity share, my total capital employed will also reduce. Yes, it will reduce. Without reducing that, how can you reduce the number of share? Without reducing the amount of total capital employed, how can I reduce the number of shares? Increase the face value of the share. Yes, one possibility. But that is not the answer what I'm looking for. If you do so, the total value of equity will remain the same now. 10 rupee share, 100 is equal to 1000. You are telling us that keep 10 share, make 1 share is equal to 100. Again, it is going to be 100 only. I'm not talking about that. I'm talking something else. How do I increase the, how do you keep the same amount of amount needed, amount employed without increasing the number of shares? Increase the, no, forget about this. I'm not asking about this. I'm going one step further. Total capital employed is equal to what? Suppose A plus B is equal to C. I don't want to disturb C, but I want to increase the, I want to increase the, I don't want to increase the number of shares. Share value, you can increase. Okay, that's one possibility. Second possibility is, if I don't want to increase or do anything on A, what I can do? I can do something in B. A plus B is equal to C. I want C to be constant and A to be number of shares reduced. Only number of shares reduced. So number of shares reduced means value will reduce. Okay. Then B will be, what is B? B is nothing but borrowed capital. If you increase the borrowed capital, owned capital is less. So you're doing something with capital structure. You're playing with capital structure in order to give more value to the shareholders, EPS. This is called a trading on equity. This is called leverage. Just keep this in mind. Next semester, you may continue with this financial management. Okay. Come back to this. Last but one, book value of share, book value per share, book value. Book value is very simple to calculate. Your shareholder fund, equity shareholder fund divided by number of equity shares. How do you find out shareholder fund, equity shareholder fund? It will be there in the balance sheet. You remember very beginning accounting equation I told you. A is equal to E plus asset is equal to equity plus liability. Now that equity is there now, that is equity is nothing but equity shareholder fund divided by number of equity shares. That will give you book value of one equity share. That book value need not to be the real value of market. Today, Infosys or HDFC, any bank or any company's equity share price may be some X amount or Y amount. That need not to be the same as book value. Book value will be different. Market value will be different. But more the book value, better the company. At least in the book, it is showing good value. That will definitely reflect in the market as well. Expected. 100% I attended all the classes. You were expected to perform better in the exam. That logic. So 100% I attend the class, but I don't perform better in the exam. That is exceptional cases. Possibilities are there. So only we are talking about general rule and then possibilities. Okay, the exceptional to that. Next, will you able to calculate this now? Okay. Next one, dividend payout ratio. Dividend payout ratio is nothing but the ratio of dividend paid for one equity share out of EPS. So dividend payout ratio is nothing but DPS divided by EPS. Dividend per share divided by earning per share. Suppose EPS is 20 rupees. EPS is 20 rupees. 15 rupees I have given as dividend. So what is the dividend payout ratio? 20 rupees is the dividend, EPS, earning per share, I calculated. 15 rupees is the dividend paid by the company to the equity shareholder. One share is getting 15 rupees as dividend. So what is the dividend payout ratio now? Sorry, sir? 0.5. How it is 0.5? 0.75. 75%. Multiplied by 100, 75% is the payout ratio. What is the retention ratio? What do you mean by retention? How much you are keeping in the company out of the EPS of one share? How much you are keeping in this case? 25. So 25 by 20 is equal to, sorry, 25% you are retaining. 5 rupees you are retaining. 5 by 20 is equal to 25%. 25% is the retention ratio. So retention ratio and the payout ratio put together should be equal to 1 or 100. In terms of rupee, 1. In terms of percentage, 100. That is dividend payout ratio. Now my question is, if dividend payout ratio is higher, is it good for the company? It's good for the investor. Why? I'm giving 75% of my earnings to you. You are getting good amount of dividend, no? You know, for investor it is good. Why? What they are earning more? They are earning 15 rupees. More or less, how do you know? You have to compare with last year, or you have to compare with another company. Last year, previous year, both are same now. You have to compare with B company, or you have to compare with last year of same company. So last year my DPS was 10 rupee. 10 rupee, 50%. Current year it is 75% is 15 rupees. So now you can say more. Is it good for the company? Or it's good for the investor? Bad for the investor. Why, sir? Bad for the company. Why, sir? That's their money only, no? DPS is what? What is meant by DPS? Dividend per, sorry, EPS. What is EPS? Earning per share. Whose money it is? Our money? Shareholders' money. Our money. If you are a shareholder in a company, our money. Our money they are giving. What is bad for the company? Company does not have reinvestment opportunity. Reinvestment will not happen. That company is a poor company. Meaning that company does not have opportunity to invest. Keep that in mind. Next semester, you'll just carry on from there. Okay. So dividend payout ratio is out of EPS, how much you are giving to the shareholder as dividend. Okay. If the company is able to earn more return than that of my investor, expected rate of return, that time the company is able to earn more return in reinvesting in the further opportunities. That time dividend payout ratio should be less, or even sometime it can be 0. So don't think that this company does not give any dividend, so this company is not a good company. That is a wrong notion. You have to go and check how much it was earning, where that earning goes, why it is not giving dividend. Suppose another company does not earn anything, not paying any dividend. That company is really does not earn anything, does not give any dividend as a profit as dividend to me. So that is really poor company, really bad company, not performing anything. So don't come to a conclusion by just having how much dividend they are giving. Okay, the last one. Last one is price earning ratio. Very, very interesting ratio. Very, very important ratio as well. Price earning ratio. Price earning ratio. Before you buy an equity share of a company, you have to look for this particular ratio. There are so many aspects are there. One among them is this price earning ratio, price to earning ratio, PE ratio. We'll say simply P bar E, PE ratio. PE ratio. Okay. So what does it mean? What is trying to capture? It is trying to capture the relationship between market price per share and earning per share. Look at this. cleverly they have formed the formula. It is not DPS, it is EPS. The money what is available for me, how much you given today, that does not matter. How much to be given to me, that matters. What you did, no problem. You are letting it in the further investment, that will grow. Okay, egg itself you are cutting and eating, that's called dividend. Egg you are just keeping there, and egg is becoming a chicken, and then that gives so many eggs. So that is called retention, reinvesting. So today only give me, but people are there, they will tell a bird in the hand is 1,000 times better than a bird in the nest. Have you heard about it? Am I telling something? 10 rupee, what is there in my hand is better than 100 rupees, what is there in the bank of other person's account. Is obligated to give. Is obligated to give. But more than that, the banks would be there. He should be there. If both are there, there should be a will to pay. If these three things are satisfied, only that 100 rupees is coming to me. Otherwise, no. So that's why people are telling, dividend you give me. This expectation of some of the investors, not all, but theory says, if it is there, it is going to grow. If it is given to you, you are cutting and eating. That means you are spending for your own consumption purpose. There is no guarantee that you are going to invest in another company and earn money. But we are assuming if you are a real investor, the return what you are getting, you will be reinvested. But the reinvestment is taking place in the company itself. They are going to give you more return in the future. Okay, this financial management just we are touching upon. That's our last one. Look at this. Market price of an equity share divided by earning per equity share. Earning per equity share. If market price of Infosys, suppose take for example, Infosys market price today is 1,800. 1,800. Okay. If you buy this equity share, how much is earning per equity share? Last year EPS, how much is the earning per share of equity of Infosys? Suppose 180 rupees is the 180 is the EPS of Infosys. 180. But how much you are spending to buy an equity share of Infosys? 1,800. So what is the ratio now? What is the ratio of price earning ratio? Market price 1,800 divided by 180 is equal to 10 times. Take another example. Another company which is selling in the market for same price of 1,800, just for our easy understanding, 1,800, but it is giving you the return of only 100 rupees. EPS is only 100. Market price is 1,800. Another company. Tech Mahindra, assume Tech Mahindra. What's the price earning ratio now? What's the percentage? 18. First, for Infosys, how much it was? 10. Which company is good now? So what is the conclusion or what is the interpretation for price earning ratio? Sorry? Has to be less. Another example you take, same third example, to be more clarity. 1,800 rupees you are buying and EPS is 1,800. Assume, hypothetically. What, madam? You are telling something? Somebody is waiting? Fine, 2 more minutes. That's all. Okay, 1,800 divided by 1,800 is equal to 1. Now you have 3 cases. One case, 1,800 you spent. Okay, all the cases you spent 1,800 to buy the share. First case you are getting 100 rupees as return. Second case you are getting 180 as return. Third case you are getting 1,800 as return. Forget about this ratio, simple common sense, which is good. The third one is good. My right is still there. I'm not selling my share. Please understand. You are the owner, one of the co-owners. Okay, fellow owners. Still your share is there only, but not selling. For keeping the share, they are giving you, or they're supposed to give 1,800. So in that case, what is the ratio? 1 is the ratio. Assume further. Fourth case. 18,000 rupees you are getting as EPS for the investment of, for the market price of 1,800. 1,800 is the investment market price. 18,000 is the EPS. So what is the price earning ratio now? Is it 0.1 or 0.01? 0.1. So that is little more better. So lesser the lesser the price earning ratio, better the performance of the company. Okay, so these are all different ratios under the group of profitability ratios. So we have discussed 4 ratios under the financial statement analysis under a tool called ratio analysis. So this is what I thought of telling you. I told you, if there is any doubt, you can ask me. Assignment is clear? Now you have run through your assignment process. You have to sit and do it, that's all. Data you have to collect. You have to perform all these ratios, minimum all these ratios. Compulsorily all these ratios. If you're capable of performing few more ratios, it's well and good. Minimum this many ratios you have to perform. And you have to make a report actually. I'll send one document in WhatsApp group or in the LMS only. What and all to be containing in the report, starting from introduction to reference. Okay, a report. Main aspect is the result of this ratio and a statement, comparison of these 2 ratios. I mean, these all ratios for the 2 companies. Clear to you? Those who are online, is it clear? Anybody has any doubt? Offline people are restless, but online people may be having some time. You are having your own time, right? Any doubt? Somebody is already catching the bus.
Yes, sir.
Yeah. Anybody has any more doubt regarding the how many more class will have? Only 2 more class will have? 2 more class. 3 more will be having. This is the 3rd class or 4th class? 3rd class. Then it's okay. 3 classes are there means it's fine. We can comfortably finish the remaining portion. Okay. So this textbook, I mean this file is there in the LMS. I request all of you to just go through this and work out all the problems with the answers. Which are the problems are there with the answer? You just work out those questions. Practice those questions which are with answer also. And moreover, you can take any textbook of, management accounting or accounting for manager or advanced accounts, any textbook, refer the chapter called ratio analysis. Okay. And go through this, work out some questions, which definitely there will be 2 questions. One is for 10 marker is there, no? Your question paper pattern? Not known? Not 10 marker? 15 mark is there. 3 into 15, 45 marks are there. 3 into 15. In that, 1 question definitely from this, and one more question is on 5 marker. So totally 20 mark is there from this particular module. So please give that much of importance for this module preparation. Okay. Thank you. See you again in the next class.
Thank you so much, sir.
Yeah. Thank you. See you.
Good evening. Yeah, bye-bye.
Thank you, sir. Thank you, sir.
Thank you all.
Thank you,
Thank
sir.
you. Thank you.